Welcome, Real Vision participants. As I was saying before the broadcast began, this is the first time I've worn a jacket during the pandemic, which reveals how excited I am for today's guest and the amount of respect I have for him. Peter Borish has been a market participant for over 35 years. I'd heard about him well in advance of the chance I got to meet him during a talk several years ago. And when Real Vision offered to put this together, I jumped at the opportunity. Peter, I'm excited to spend time with you today.
Thank you. I am too.
Now, for those of you who are going to be watching this, Peter and I met yesterday, and he gave me sort of broad and wide length to be able to ask whatever questions interest me. For those of you who know me, I have a background in psychology, PhD in psychology. I've coached investors, as does Peter. But on the mental side of things, I've coached athletes for years. So we're going to have a little psychological slant today with the intention of tapping the mind, one of the most articulate people I've met in the investing community and a market participant, like I said, for over 35 years. So we're going to tap into that mind and hopefully learn some good things today. So Peter, I want to begin with just an opening statement. As a participant and an observer of the market, having a president of Computer Trading Corporation now, but being mentored by Paul Tudor Jones, one of the legends, and seeing sort of the invention, innovation, evolution, and adaptation of the markets. Talk to me in retrospect about how the market has evolved in broad terms, in your view, and what's evolving in front of us in real time.
Wow, great initial question. So I don't have 35 years to go over 35 years, so I'll try to do it relatively quickly. So the major change is the speed of technology is not technology. And I think that is a error that many people make. Speed has always been important. Back in the earliest days, if the price of gold was higher in New York than the price of gold in Philadelphia, the fastest horse that went from would sell New York and ride to Philadelphia and buy gold in Philadelphia. Arbitrage has been around forever. Markets work. If you start from that premise, then everything comes out. You don't even need to be that old. If you've got a child of 9 or 10, if you ask them, why are the Knicks tickets less expensive than the Warriors tickets? Well, people want to see Steph Curry. It's as simple as that. They get it. Markets are inherently understood. So what has changed is the number of markets that one can participate, the ease of access, and the speed of the response mechanism, both from your orders, execution, and the speed of news, which is disseminated. So all that comes together and says, okay, what's signal and what's noise? And that by far and away is the most important evolution in terms of, I think, trading today is you have to trade your own personality. I know you've spent a lot of time on this. I can't trade like Paul Jones. I can't trade like Steve Cohen. I have to trade like Peter Borish. Unfortunately for me, that's not as good as them.
One of the things I really respect about your mind and about how you think about the world is you tend to take a lot of disparate information and synthesize it and distill it. I mean, even so far.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1 to get a month's access to this incredible treasure trove. I don't think you can afford to be without it.
Here today, markets work, right? And you have to trade who you are. I mean, you're a born teacher. Let's talk about that statement for a minute. What's the belief undergirding the idea that markets work? What do you mean by that?
I mean that when we're successful as individuals, we tend to take credit for that success. When we're not successful, we tend to blame others. When we're blaming others, we're essentially the large they, or the markets don't work, or there's a manipulation, or the government's done this, the Fed has done this, or a big trader has come in. Just we've seen, with the volatility today in the markets. By the way, just as a total aside, today is rollover day in the futures, which is an inherently volatile day. You need to know these things going in. Is it useful information? It just has to be there in the back of your mind in terms of your risk, which I'm sure we'll get to. So markets work, as I said, at the most basic premise. In the short run, it's always a supply and demand for money. So if your time frame is longer than that, then you don't have to worry about it. But if you're trying to trade actively and in the short run, you must have a discipline. And one of the things I'm going to say, 2 lines that I always took away from me from Paul Jones. 1, discipline before vision, and what's obvious is obviously wrong.
Discipline before vision. Extrapolate on that just a little bit for us.
So we like to think, and this is part of the business of markets, that we're smarter than everybody else. And the markets don't grade on a curve, and so you go in there. So you may have a view. Wow, Tesla's overvalued. I'm going to short it. Well, you have to have that discipline to get out, because that's there. So you can probe and lose a little. You can probe and lose a little. But if you don't have that discipline, you are going to be taken away. And it's the same thing as in markets, as in sports. The mentality, in my mind, is extraordinarily similar. If I could just go for another minute, one of the things that I know that you always talk about, and having started in research, I hope you don't mind, but I listened to a number of your discussions and talks on your website, is you talk about ego. And many people feel that if you have a big ego, you don't have discipline. But the people with the largest egos have that discipline. They can say, you got me today, but I'm going to get you back tomorrow with 100% interest. So I'm wrong on this position. I'm strong enough to get out, but I can get back in. And the best traders in the world, they understand that. They say, okay, you got me. But if I take a series of small losses, and this is the school I grew up with, which is, if you get paid in our business if you make new highs, if you're in incentive fee territory. As long as I'm close to sticking my head out, I can get paid. If I fall too far in the ditch, it's going to take me a long time to get back to even and make money. And of course, that's the inverse property of negative returns, and we don't need to get into that.
So you brought up an interesting concept, this idea of ego, and it's, in pop psychology, it's all the rage these days to vilify the ego. But, in psychology, ego is synonymous with self, with identity. And so everyone has an ego. Everyone has a sense of themselves. And I think where it becomes dangerous is when people, because the ego is a filtering mechanism, right? We see ourselves a certain way. And when the markets are not rewarding our view of the world, it's an offense to the ego, and therein lies the source of many cognitive biases. So I agree with you on the point that ego is required. A healthy ego is required largely because of the psychological punishment that the markets can take. Jack Nicklaus talked about confidence being an expression of ego, as being the buffer against the demands of golf, that you need a bit of a buffer from the demands of sports. And I think there's a real parallel in professional golfers and professional investors. Quite a few commonalities. Let me ask you a question. One of the things that is a bit of a known in golf is that there's a lot of different ways to get it done at the professional level. Proverbially, a lot of different ways to skin the cat. So, for example, Rory McIlroy is arguably one of the most talented golfers of this generation. He's got the same golf swing he had when he was 6 years old. He rolls out of bed and hits the ball straight, and so he's just, pure talent. And there are a number of investors I've met who I think have a version of that. And for people who don't have that talent, the IQ points, the horsepower, they compensate. They either compensate in the golf world through work ethic. They'll just work harder than the more talented people, or they'll compensate through being more organized. And I've seen a version of that with professional investors, that there's horsepower. And I'm not going to give my list. I'd like to hear, in your vast experience, having participated in so many different types of investing with, at this point, I would imagine thousands of people and thousands of hours of dialogue, and having been a mentor and a teacher, what are the profiles that work in investing? What do you see that works? And for the viewers of Real Vision who might be new to the forum or new to investing, young investors, what cautions or guidance might you give? I know that's a big question, but let me break it down. What works? What might not work? And what advice can come from that for young investors?
Wow. So I think what works by far and away, most importantly, is to take away the emotion of the moment, and therefore pregame and try to do most of your work when the market is closed. So you want to be an actor, you don't want to be a reactor. So this is the difficult part about this business. You can work all weekend, you can have a game plan, you can do some research, and then the cash stock market opens at 9:30, and that could all be out the window by 9:40.
I'm laughing because I have a portfolio manager I work with for whom that describes their day-to-day, the reality of their life. That's a very real thing. Yes. I
think that that's really important, because if you don't do that, when you're reacting, there's 1,000 reasons to talk yourself out of a trade. So you will talk yourself out of that trade, and then it'll work your way. And then you're going to lose your discipline because you're really mad at yourself for not having done that. And then you'll force yourself into that direction of that trade because you lost your discipline, and you'll have bad trade location. To me, trade location is everything. So we talked before about personality. I'm a terrible spread trader because I'm too competitive. I want to win on both sides of the trade. So being long gold and short silver, I can't do that, because I want gold to go up more than silver does. But if silver's going up, I can't stand myself for being short silver. So I have to recognize that. I'm not a good spread trader. I'm also terrible at averaging into positions. If someone says, well, I'm going to buy XYZ, and then if it goes down, I'm going to buy a little more. And if it goes down, I'm going to buy a little bit more. That is not the way that I was taught under Paul Jones, who says losers average losers. It becomes trade location. So you have to deal with that. So if you pregame, which means not just the entries. So I have this whole trading presentation, and my first slide is always entry is easy, exit is hard. And I'll also say, just keep in mind, that's just like relationships. And it's so important to maintain that fact that before you do the trade, you have to have an exit, both in terms of risk, of loss, and of profit. And one of the things I've worked with a lot of CTAs who are on here and have done some great Real Visions is that when you have sort of a model-based trend-following CTA, their point of entry, their risk reward is fantastic. Except the minute they start making money, it gets backwards. And in fact, because the faster they make money, so trading is a second derivative world, right? It's the rate of speed. So if you make a whole bunch of money, but you can't move your stop, then you can give it all back. Again, that's not how I was taught. That's not my personality. So process, which we think that really good traders wing it. That's not true at all in my mind. Really good traders have a process and they stick with it. But of course, they evolve as new information and new tools and new techniques become important. For all you at home who are comfortable with their screen setup, it's really hard to get them to change over time. The best example is everybody that hung on to their BlackBerry for so long And now they can't imagine how they, survived without an iPhone or an Android.
Boy, I loved the screen, the keyboard on those BlackBerries, though, Peter. I got to tell you, they typed really, really well. Peter, I'm going to ask you a bit of a personal question, if you don't mind. And this is rooted in the research I used to do in golf psychology, where I would ask my first book, Fearless Golf. One of the two of the questions I asked 100 different professional golfers was, what's the biggest obstacle that you've overcome, to reach your success? And then how did you overcome that obstacle? Because one of the things that we know is the path to the type of success that you've had, is not linear. I would imagine. I don't know that to be the case, but I imagine just like a portfolio and just like the stock market, it's not up and to the right. Although risk managers always want profits to be up and to the right in a straight line, that's generally not the reality, and that's true of the pattern of success in life. So if you were to look back at your 35-year career, share with us, and let's make it sort of trade specific or investor specific, if you think that's relevant. What was the setup? And then, what was the obstacle that blindsided you? What hit you? And then how did you overcome it?
So I'm going to be, I think maybe that's your skill set. I'm going to be very personal here and go back and try to be very honest. So when we were starting at Tudor, and Paul was a true entrepreneur. He brought me on, and even to pay the bills, he would have to go back down to the floor until we raised any money. And then we had success, and I had a lot of success as being known as the guy that called the 87 crash. So here I am as a 28-year-old, just like an athlete. I had tremendous success, and for the first time was making serious money. And I think I made a lot of the mistakes that I see in young athletes today that make a lot of money when they're young. I went to public school. I, went to University of Michigan, and I got at the Fed, and I thought I was on this path that I could do no wrong. I lost some discipline, I think, because of that. And in the sense that my research was going to be right. So the things that I said earlier was about the market being right and me being wrong. I just thought it was going to be the opposite, that, hey, I had this success. I was smart. I was using these tools. We were using this technology. And one of the things that we were able to do is we applied this new technology to markets very early on. The discipline of Paul's trading on the floor and in futures, which were more leveraged than traditional equity markets. And as the financial futures around the world came on board, and we saw that in 89, near the end, where we thought, well, Japan's going to be another one of these issues. And I'm pounding the table, but thank goodness that, Paul Jones had that discipline as a trader and that ego strong enough to probe and get stopped out. Finally, in 1990, when it turned, we got paid. So the lesson for me at a very young age was, hey, I had success, but success is not 100% dependent on yourself. And flash forward a half a decade or a decade later, the hardest thing for me when I left and started CTC and they seated me and they had a CTA and we had models is when I had a bad day, I could walk down the hall, I could sit on Paul's couch and go, why the hell am I in this business? And he could, as the boss and as better trader than I am, focus me and get me pumped up. Sometimes it's just as simple as, hey, this is the life you chose. This is the way it is. If you don't want this personal volatility, then you shouldn't be in this kind of business. When I started my own business, I couldn't do that. I had to be the person that other people came to when we did this. And we had a more volatility. We had more markets. So by the end of the 90s, you had to have a 24-hour trading desk. You had to deal with cross correlations. I never got the phone call at 3 in the morning. I'm still waiting for it, by the way, saying, "Hey, Pete, I just want you to know you're making money." I never got that call. I always got the other call.
Yeah.
So
yeah, the 3 a.m. phone calls are never infused with joyful news, are they?
no, never. So that's a long way of sort of saying is that, young guys have all the moves, but old guys win championships.
It's a game that rewards mature champions. I sense that. So one of the things that, and this is really the forum where you and I first connected, where I first knew you, has to do with Robinhood, which is such a wonderful organization that I believe you're a co-founder of, correct?
Yes, thank you.
And I tell you, I was pretty new. I'd come out of sports psychology and academia and academic research into the world of investing. I've always coached a few investors, but Steve Cohen is really the one who brought me in full time at Point 72 about 6 years ago. And it's interesting because my view of Wall Street and the investment community was largely informed by the movies that I'd seen. The Wolf of Wall Street and Wall Street with Michael Douglas and so forth. And one of the things that I've discovered firsthand was that it tends to be populated with a lot of really wonderful people. In fact, I would say disproportionately really incredible people, who have all the characteristics I like in somebody: rigor and discipline and intellectual honesty, compassion, emotional EQ, IQ, but also real heart. And you embody that, and maybe having been trained in the helping professions and the liberal arts, really appreciate that, which is maybe why I'm such a huge fan of yours. You spoke earlier about, I started making real money, and we talked about wealth and the world of wealth, the life of wealth that you and I get to you live and me on some level observe and coach. Where did your conscience come from, and what do you, if I were to give you unlimited authority to say, listen, here are the rules for anybody with a net worth over, pick a number, whether it's 10 million or 100 million, here's how to live a life. If you want to be wealthy and do it right, what's the genesis of your compassion to help others? And what would you advise others who've accumulated wealth, how to distribute that wealth to not only to help other people in an altruistic sense, but we've both discovered that, by giving, you receive, that the more you give, the more you raise others, the better it is for you personally. Talk to me about your journey to that part of your journey, not the accumulation of your wealth, but the next stage of your development.
Well, my mother is one of the few people her age, unfortunately, knock on wood, she's turning 89. She has a master's in social work from Columbia University, one of the few women back at that time. So I think these things philosophically are instilled by your family, your relatives, your parents, your culture, your synagogue, your church, your mosque, whatever it is at a young age. And when we first get into this business and we're on Wall Street and we're making some money, it's always that, okay, the Wolf of Wall Street, he who has the most toys wins. I think as you get a little older and get some perspective, you're like, you know what? I've never seen a hearse with a luggage rack on it. You can't take it with you. And then one of the issues is we live in New York City. I live in New York City. And it's the greatest city in the world, even in this pandemic. But I try to teach my kids that, is it right that you have everything going for you, but 30 blocks away, people are living in poverty? Why is that? And do you want to do something about it? It's not for me to preach somebody what to do with their wealth. Their priorities don't necessarily have to be the same as mine. The Robinhood priority is mobility from poverty, helping those who are less fortunate. But if you do something with your wealth, and then I'm okay with that, whether that's U.S. or foreign or museums or art. There isn't any one right word, but the accumulation for accumulation's sake, I think, gets old fairly quickly. And that's going to be the entire culture with whom you're surrounded, both from your parents, from your siblings, from your spouse in particular, and your work environment. And is the work environment a culture of doing that? You know, before we started Robinhood, Paul and I, we saw it. It goes back to Eugene Lang, who did the I Have a Dream program. And it was on 60 Minutes. And he said at sixth grade class in the Bronx that he went to, if you get through 12th grade and you go to college, I'll pay for your college. And we thought, wow, that was great. Cool. So we reached out. We had some friends, and we did one at Bed-Stuy in Brooklyn. And then all of a sudden, we realized that was too late. The mother is asked, well, what about my kid in fifth grade? What happens when they leave middle school and they go to high school? If you don't have any means of tracking them, of keeping hold of them, of helping them get through high school. So that was part of a holistic approach. And to me, that's so much more meaningful. The game, it's like sports. And that's, I make a good trade. I feel good about it. The scoreboard, unlike wins and losses, is P&L. But in life, the scoreboard is improving others people's lives. And there's nothing better than that.
Good. Spoken from a man who actually does it. So it's not just a homily. It's a real thing. I know how much time and effort you give to fostering that cause, among others. So I want to step back just a little bit because there's a portion of a question that remained unfinished. I want to hear about a setup, an actual setup for a trade that you had, where there's four categories that investors are always living in, psychologically speaking. It's bad process and they lose money. And there's category 2, bad process, and somehow they make money. They get lucky. But then there's good process and you don't get paid. You did everything right. You got the setup, you made the trade, and for some reason, price action doesn't go your way and you don't get paid. And then, of course, where everybody wants to live, which is great process and you get paid for doing good work, right? So the four categories that my investors that I'm communicating, and they all have their own psychological responses that come with them, either pride or fear or depression, regret, and various things. I'm interested in a situation where the setup was maybe you thought you were doing good work, but in retrospect, it wasn't good work. And not only didn't you get paid, but you took a big hit and you felt the pain, because pain seems to be such a common, the market delivers so much pain to professional investors. And so I'm constantly dealing with investors. What do we do with the pain and the hurt, and how do you carry that? So if you're willing to talk to us about a situation, or maybe you did great work and didn't get paid, but a real blow to your confidence. And then what did you do in the moment? What was the setup? What was the trade? And then what was the aftermath?
So that's so meaningful to me, because every successful trader, portfolio manager that I work with, they remember their losses. They don't really remember their gains, because you have to learn from that. And I subset what you're saying a little bit, because I call it's a probability business. So you could do everything right. You have the correct setup. You put the trade. And I define a good trade as if that's all there again, would you do the same trade? Because just because it's all there and it loses money doesn't mean it's a bad trade. That's where the probability business comes into play. You start losing your business when you have a losing streak and you lose your discipline. I used to say, and you see this a lot with model-based traders, oh, I got to keep everything secret. I can't share it. And I was like to our investors, I have no problem. I could put my signals up in Times Square, because the minute I go through a drawdown or a losing streak, no one's going to follow them. They're just going to say, well, there's another idiot. And during that streak, I'm definitely going to feel that. So where I really made some personal mistakes is when the data in the market started moving significantly to overnight liquidity. And I would think, you know what, I'm not going to leave stops in overnight because they're just going to pick me off. And whether that was in the FX market and, you're doing futures and EFPs, not to get technical, and then, the basis will change and they'll say, well, you got stopped at the high. In my life, I bought in the high far many more times than I've sold the high because they are out to get you. So my biggest loss is sort of like, okay, I got picked off in the market overnight. I'm not leaving a stop in there. And then one or two times it'll pay off and you'll say, you see, I would have got stopped out, but now I've had success. So that is the worst combination you can ever have. Lose a little discipline, have a little success, because the market is reinforcing your bad behavior. So then they are going to swallow you whole. So what happens? You have a position on, and oftentimes it's in the equity futures markets, and you try to go to sleep. And if you're really into it, you wake up in the middle of the night and you check, and then it's kind of through your stop, but you're like, it's just the middle of the night. It's the crossover. And I'm really, really good at making excuses. That's because I have 4 sisters, but whatever it is, I can make great excuses. Oh, it's just a cutover from Japan to Europe. So it's an illiquid period there. I'm going to do it. And then you come up and then you wake up at 6 a.m. and you're like, holy shit, this thing, excuse my language, is way through my stop. Now I definitely can't do anything. I got to wait till the U.S. market opens. And then by then it's even further away. So now you are not trading at all on your terms. You are trading on the market terms. Once that switches, you're doomed. And then eventually you get stopped out at a loss that's 5 or 10 times greater than you thought you were going to do. And that's just emotionally devastating. So I deal with that because I'm human and I've screwed up a number of times. As a discretionary trader, I can put myself in trading jail and say, okay, you need to get your head straight. I get to go across the street and sit on a park bench and put my head in my hands. But like an athlete, I'm allowed to feel bad until the next game starts. The problem in this business is that there's only one day off in the year, New Year's Day. They don't celebrate July 4th in Britain, as far as I can tell. And they're not celebrating Thanksgiving in Japan. So if you're in this business and you're really into it, then on Thanksgiving Day in the morning, you better be watching what's going on in London. And I can assure you that there's been some really big moves, particularly in the precious metals at that time. And now if you get into away from futures or cash, and then you're trading options, Thanksgiving's on a Thursday, and then you got a Friday expiration, and something's going on, and there are gamma moves, you have to be into this business 100%. And if you want to take it off, then get out of your positions, because the market will control you, and then you've lost.
Yeah. You hit on a really important point. One of the things that I've often said, I've had the good fortune of working with some of the best in the world in a variety of domains, sort of the thousandth of a percentile in the tail end of the distribution. And that's been I've worked with the best wakeboarder in the world, arguably couple of the best golfers of all time, some of the best investors, some of the best NBA basketball players. And one of the things that psychologically is fascinating is you come to find that call it the BOTB, the best of the best, in different domains there's more in common across domains when you're really good at something than within a domain. So for example, colloquially, I would say that, Tiger Woods has more in common with Steve Cohen than Tiger Woods has in common with, for example, Sergio Garcia, who's a very good golfer. Sergio Garcia has won the Masters and has probably won 40 tournaments worldwide. But he's not the best in the world, right, at this thing. And so when I have a conversation with the best golfer, the best wakeboarder, some of the best investors, you realize there's some commonalities there. And one of them is what I call, it's not a very smart word, but it makes sense. It's called everydayness. It's that they show up and they're there every day. Hank Haney, who coached Tiger Woods, said in his time coaching Tiger Woods, he not one single time he never saw Tiger Woods hit a careless golf shot. Tiger pays attention to every shot he hits. He shows up. He's present. And if you've ever had the privilege to be close to someone investing who's great, like a Paul Tudor Jones yourself, or in my case, Steve Cohen and Justin LaBelle, Harry Schweifel, and Alex Silverstein, and many others, they have this everydayness. They're present for every moment of what they're doing, and psychologically, that's the most fascinating thing. Steve Cohen. I asked his wife once how many tradable days, how many market open days had he ever taken off over the course of 40 years. 10,000 trading days approximately. He had taken 5 days off. That's because he was in the hospital. Like, he literally couldn't trade because he was unconscious. Other than that, market's open, Steve's trading. On Sunday, he's doing idea calls. And that everydayness to me is so admirable because, writers write every day, professional writers. So you're talking about, hey, if it's Thanksgiving, nibble on your turkey and go check what's going out in London. Who have you seen who demonstrates that all in, we call the blending of vocation and avocation, when work and hobby blend and merge so that, like Michael Jordan, you are what you do. Kobe Bryant, you are what you do. It's the same thing. Who have you seen in your life who really embodies that? Maybe somebody who we don't know. And have you ever seen anybody get away with it not being that way? Like, has anyone been super successful doing it any other way?
Well, the latter answer is very easy because luck is not a strategy. And so this is a business that's all consuming all the time. I think I said to you when we had our talk and in my earlier Real Vision, I said, when I talk to younger traders, I'm always asking them, what's the first thing that you do when you get out of bed in the morning? And if the answer is go to the bathroom, that's an X. It needs to be, I'm looking at what the S&P futures are doing. Then I can go, because you need to be completely committed to this business. And if you think of in my world and sort of the global macro trading business and the legends who are there, whether it's George Soros or Stanley Druckenmiller, I've learned from all of them. I've had the honor really of being able to listen. Sometimes I talk to them and I'm like, you may not remember this, but back in so-and-so, you said this line, you may have thought it was a throwaway line, but it really connected with me and I've stolen it and I use it or I think about it. Those are the type of people. And the issue with this business, and it's a lot to me, I don't know golf that well, but I think in terms of like basketball, you watch a basketball game and you're like, hey, that's an open shot. He should make it. I can do that. You see that in trading because everything looks obvious after the fact. And so, you talk about that and you say, well, look what's happened over the last 6 months in some of these tech stocks. I should go buy them all. And I'm like, well, unless you can go back 6 months and buy them, that's all irrelevant. It's the question of what's happening tomorrow. So those traders and people, and also in coaching and sports. So if I can talk my own book for a second, because I'm really good at it. So my son was the head manager at Michigan, and he had the opportunity to work with a young Duncan Robinson, who's now sort of the rage of the NBA, who wasn't drafted and worked and had one offer at D3 at Williams and then sat out a year and went to Michigan and et cetera. But his work ethic is exactly what you're talking about. And it's so amazing to me when I think about where he is today and the culture and him, because he continued to work, but part of his success is the people are around him. A good coach puts you in a position to succeed. If you're playing a game and a basketball game, and if you take a shot and you miss it and you're looking over at the bench because you're afraid you're going to get taken out of the game, you have no hope because you already have that element of doubt in your mind. If you talk to Kobe or you listen to Michael or any of them, right, they're always like, hey, every time I shoot the ball, I shoot it because I think it's going in. And I'd have this same issue of a trade. Hey, you're long the euro. Well, why are you long the euro? Well, because I think it's going up, and here are all the reasons why I think it's going up. And then the investor goes, but it went down, and you lost money. And I'm like, well, I actually only in your account because I don't like you. For everybody else, I made money. No, that's just the way it is. I would have never done the trade if I didn't think it was going to be successful. But you're going to lose, and you're going to lose a lot, and you're going to miss a lot of open shots, but you have to have the confidence to move on. That's what I've learned from the best traders. Because as I said before, you can always talk yourself out of doing something, and that's a mistake.
That's right. That's right. So you talked about, the tech stocks, FANG stocks are all going up. It's easy, just buy them, but you can't, there's no time machine. So you're not going to go back in time 6 months. So it's a forecasting on some level. It's a forecasting business for every investor. You are credited with anticipating and being really explicit and verbal about the crash of '87. And you and Paul put a big trade on, made a lot of money. And so you know how to do the work, and you know how to forecast, and you know how to deploy capital into it. That's a known thing. Where do you see from here projecting forward? There's two questions I want to ask. There's a view out there that that quants, that artificial intelligence, that machines and machine learning are going to take over the universe, and there's going to be no role and no place for the individual human investor. That everything is just going to be run by machines, and people are going to get proud out. Okay, so that's take on that. And then secondarily, where do you see the money being available going forward? Is it in cryptocurrency? Is it in macro? Is it in healthcare? Like, where do you see the money being available to be made? Not the easy money, because there is no easy money, but still some room.
So that's a very broad question. And I'm going to go back to one of the guys I just mentioned. If you read Soros on Soros, and he talks about inflection points in the market. So in the core of the trend, then you want to be there. So in the core of the trend, quant strategies, AI strategies, alternative data strategies, because it's all utilizing the recent past or the more distant past to try to forecast. But I look at markets a little bit the way that I look at, weather forecasters. We knew a hurricane was coming just a couple weeks ago. Everybody knew it was coming. They got the direction wrong. They got the magnitude wrong. They got the wind speed wrong, and they got the land location wrong. But everybody prepared that there was a hurricane. In markets, and they have that cone of uncertainty. We think that there's only going to be that one line that's going to be accurate. When you do your work, you have to take into account that's where risk management is, essentially, is around that cone of uncertainty. And depending on your approach and your pattern, then though you can have a wider cone of uncertainty if you're willing to take more risk. So I look at the announcement from the Fed and Jerome Powell that they're changing 40 years of policy that started under Volcker. And I'm thinking to myself, okay, if we're taking 40 years of policy and changing it, expecting the same outcome is not necessarily the best thing. So all those tools that you mentioned, which were really good under that old regime, may not be applicable. That's where forward thinking comes into play. And we're seeing that right now. So we just had the fastest down in history in March. We've had the fastest up in history. Then we had the fastest 10% correction in NASDAQ last week, all first times. So if you're going to say, well, I'm going to use all my history to forecast based on all first times, that's a mistake. So what does that imply? Yeah. It means you should be trading smaller because that cone of uncertainty is much wider right now. I also believe that math works. So if Apple continues at the same rate of speed for the next 5 years that is done over the last 18 months, its market cap will be larger than the entire stock market is today. That's just the impact of compounding. That's not possible. So it could be a fantastic company. It doesn't inherently mean it's a great investment in a stock. To me, it means it may be more of a great trading vehicle because it's liquid and will be moving around. But if you're going to say, what's the next best investment over those years? Well, first of all, my crystal ball gets foggy, but I would say for sure it's not Apple. And they say, well, how do you do that? So now you go back to me and say, I'm an economic historian. Let's go back and look at the top 10 market cap stocks, the end of 79, the end of 89, the end of 99, the end of 09. And we don't have the next 10 years at the end of 19. All I can tell you is on average, only 2 or 3 of those top 10 market cap stocks were in the top 10 years later. ExxonMobil, Kodak, DEC. You think about all these IBM. You could think of all these stocks and you're like, well, this, and this happens. Yeah, of course, I'm looking backwards. And as I said, Apple was discovered in a garage or started in a garage in 1975, but the bulk of its market cap happened over the last 18 months.
Right. Brilliant. I love it. We are winding down, and I'm thankful that I got to ask all the questions I wanted to ask. In the next couple of minutes, the current rage these days are Ray Dalio's Principles, and a best-selling book. And I know Paul Tudor Jones has his rules for investing. In fact, I had those posted over my desk during my time at Point 72. A very clean thinker, Paul Tudor Jones is. I asked you this yesterday, and I'm going to ask you again. And I don't need the complete list. Give me 3, if you would. For a young or a neophyte or even a mid-career investor, what are the 3 or 4 rules that if someone were to say, hey, Peter, mentor me. I want you to be my coach and my mentor and lead me into my career. And you were to say, okay, Daniel-san, you were Mr. Miyagi, Daniel-san. Here are your 4 rules, right? Here are your 3, 4, or 5. Here are the parameters, the rules we're going to live by. What are those rules?
Well, if we're going to go back in television, I would always start with patience, grasshopper. That number one, you have to learn, and that you have to look at this as an accumulation, not hitting a home run all of a sudden. Home run hitters have a lot of strikeouts. So the number one thing, as I said before, you have to know thyself. And when I think about Ray Dalio and I think about those principles and I think of radical transparency, that's what that is. Be open to others who can see you as you can't see yourself. You have to be able to step outside yourself and look in and be brutally honest. What was my mistake? The other thing is you have to do your own work.
So I hear patience. I hear self-awareness and humility, right? Go ahead. Self-knowledge, right? What else?
You have to do your own work. There are no shortcuts. We all want the guru to come out there. And we see that all the time in the financial media. Sometimes I'm on there as well. But I always try to say, hey, the right to change my mind starts as soon as I put my tongue back in my mouth. That do not take what I say as the likelihood that it's going to continue. Many people believe in, do as I say, not as I do. And I'm always no. The great traders do as they do. Listen, not what they say, because discussion are 2 different things. And we can have that cocktail party. Oh, yeah, I'm long Apple. You're long Apple. Everybody's long Apple. You pat yourself. The good trader will say, hey, this is an opportunity for me to get in that other room where I'm the only one and I'm short. As long as I have a stop, I can do it, because if I'm wrong, you can always squeeze one more pre-social distancing in the subway car. But when they come over running to you, it's why markets go down. People saunter into the movie at different times, and then they all want to leave at the same time. So that's really knowing yourself, doing your homework is extraordinarily important. And the other thing is, yes, they are out to get you, so don't take it personally.
Well said. Yeah, that ability to have a differentiated view and conviction and swim against the stream is I really value that in investors who are original thinkers, and can see things out of consensus. So, man, what a wonderful, wonderful, insightful time, Peter. Thank you so much. I learned a lot. I hope the viewers learned a lot, and I hope we get to do this again at some point.
Oh, it's a real honor just being here with you. I think you underestimate how good you are at your own coaching and the teasing out of people. Made me very comfortable. Thank you.
Wonderful. All right. Have a wonderful day, my friend. We'll chat soon.
You got it. Bye-bye.